Welcome to This Explainer. Today, we're unpacking one of the absolutely most transformative concepts from the psychology of money. We spend like 90% of our time staring at spreadsheets, analyzing stock charts, just trying to pick that absolutely perfect time to buy or sell. But honestly, the truth is that 90% of our financial success actually comes from right between our ears. Yeah, understanding how we react to money, especially when things get, a little turbulent, is literally the ultimate cheat code to financial independence. Okay, let's dive into this. It's the ultimate question, isn't it? Want high returns? I mean, of course you do. I do too. We all want to plant a tiny little seed today and just wake up tomorrow to a massive money tree. We all want our investments to double, triple, to just grow exponentially over time. It's a completely universal desire, right? We all want the reward. But, well, as we're about to see, wanting the reward and actually being willing to do what it takes to get it, those are two completely different things. So here's the stark reality check. Nothing is free. Every single reward in life comes with a cost, right? Like if you want to be in peak physical shape, the cost is sweat, sore muscles, and dietary discipline. If you want a super successful career, the cost is long hours, stress, and continuous learning. Money and investing are absolutely no different. If you want those high returns, there is a bill that must be paid. But here's the kicker. In the financial markets, this bill is invisible. It doesn't look like a standard invoice. It's not just, deducted from your checking account in dollars and cents. And actually, that is exactly why it is so incredibly hard for most folks to recognize. Let's picture two investors facing the exact same market crash. Red arrows are flashing everywhere, the news is just screaming about imminent financial ruin, and portfolio balances are dropping by the minute. It's scary. Now, our first investor, the panicked investor, gets completely overwhelmed by fear and frantically hits that sell button. They liquidate the whole shebang just to make the pain stop. But now, picture the second investor, the patient investor. They're watching the exact same news, seeing the exact same red arrows. But they stay calm. They actively choose to accept those wild swings in price, and they keep their eyes fixed firmly on the horizon. They're thinking in decades, not days. Fast forward 10, 20, or 30 years, and the outcome is incredibly clear. That second investor, they become wealthy. Now, it's really important to pause here for a second. We aren't shaming the panicked investor at all. I mean, feeling fear when your hard-earned money is dropping in value is a completely normal, hardwired biological response. We are literally designed to run away from danger. But in modern financial markets, running away from a temporary drop just locks in a permanent loss. The patient investor didn't win because they were somehow immune to fear. No, they won because they didn't let that fear dictate their actions. They knew that patience is the slow, kind of unglamorous tool that actually builds wealth. So why exactly did the patient investor win? What was the fundamental shift in their mindset that let them just sit on their hands while everyone else was running for the exits? It wasn't that they picked better stocks, and it definitely wasn't that they had some magical crystal ball. It was a profound difference in how they viewed the really bad days in the market. So the crucial point is this. They completely understood that volatility, those wild, scary downward swings in the market, is simply the price of admission for long-term wealth. Think about the best roller coaster in the world. To ride it, you got to buy a ticket at the gate. You don't view that ticket price as a fine for doing something wrong, right? You view it as the required fee to enjoy the ride. And smart investors view market volatility the exact same way. It's not a punishment for bad investing. It is literally the mandatory entry fee for high returns. When you buy that ticket to the financial markets, the receipt lists three very specific psychological costs. First, fear, that gnawing, awful feeling in the pit of your stomach when the market drops. Second, uncertainty, the total inability to know what's going to happen tomorrow, next week, or next year. And third, temporary losses, just watching your account balance drop by 20 or 30% on paper. Recognizing these three things not as disasters, but as normal, totally expected parts of the wealth building process, that changes absolutely everything about how you manage your money. What separates the masses from the masters is how they view this exact receipt. Most people, well, they want the impossible. They search relentlessly for quote-unquote safe high returns. They want the massive rewards without experiencing any of the discomfort. And because that just doesn't exist, they end up quitting during bad times, avoiding risk entirely, and completely missing out on long-term compound growth. Successful investors, on the other hand, they accept that temporary discomfort is just part of the deal. They pay the fee, they stay patient, and they keep investing, month after month, year after year, regardless of what the scary headlines say. And this brilliantly illustrates the concrete habits that separate the wealthy from the rest. First off, you have to accept volatility as a completely normal feature, not a bug, of the system. Don't ever expect smooth success. The road to wealth is covered in potholes. You must think long-term, zooming out to view your life over decades. Ignore the short-term noise because remember, financial news mostly exists to sell ads, not to make you rich. Control your emotions because unchecked fear will absolutely destroy logical decision-making. And above all else, stay invested during periods of uncertainty. So the next time the market takes a dive, use this little mental cheat sheet. Do be patient and focus exclusively on your long-term goals. Consciously accept that emotional cost of success. But whatever you do, don't panic sell into a declining market. Don't expect to get big financial rewards without taking on some level of risk. And definitely never chase people promising unrealistic guarantees or risk-free high returns. Those are complete illusions, for sure. It all comes down to this really simple but profound truth. Every reward has a price, and volatility is the price of wealth. If you try to avoid the price, you simply will not get the reward. You can't have the sunshine without occasionally weathering the storm, right? Recognizing this fee for what it actually is, a toll on the road to financial freedom, is quite literally the single greatest advantage you can give yourself as an investor. As we wrap up this explainer, this is really the ultimate concluding thought. The market does not reward comfort, it rewards patience. Look, it is incredibly comfortable to sit in cash. It's comfortable to sell everything when things look scary just so you can sleep well at night. But the market doesn't pay you for being comfortable. It pays you for your endurance. If you want spectacular long-term success, you have got to train your mind to tolerate short-term pain. So I'm going to leave you with one final question. Knowing that the cost of high returns isn't actually money, but the emotional fortitude to withstand fear, uncertainty, and temporary losses, are you willing to pay the price? Take a hard look at your own investment strategy and ask yourself if you're truly prepared for the next time the market asks for its admission fee. Thanks so much for joining me on this explainer, and I'll catch you next time.